For the very first time in our investigation, we unmasked the killer of Ravindra Matre.
In 5G, we have to stand with the world, and in 6G, we have to lead the world.
Winning a Grammy was an absolutely surreal experience.
Hello and welcome. You're watching News 9. I'm Shweta Kothari. The top story we're tracking at this hour: Chinese real estate market is struggling after Evergrande and Country Garden. China Vanke is the latest to feel the tremors, with the sector contributing nearly 30% to China's GDP. Its troubles have prompted a $138 billion government bailout, raising concerns about the country's economic stability amid mounting debt and failing demand. Take a look.
Remember China's massive collapse of the real estate giant Evergrande? It all started with that. And then there was another player called Country Garden. And right now there's a smaller player in China's popularly called defunct real estate market. China Vanke is now feeling tremors. China's real estate sector is in an absolutely messy spot. Real estate has been a major driver of its economy, contributing almost 30% to the GDP. But reports are now suggesting that that share could come down to about 15% in the next 2 decades. But even that 15% seems a bit of wishful thinking if you were to look at the numbers as they stand today. Now, last week, the Chinese government announced infusing a $138 billion stimulus to bail out the crashing real estate sector. The bid is to coax state-owned enterprises to buy 4.2 billion square feet of unsold houses. 4.2 billion square feet is massive, and I'll try to put that in perspective for you. If you were to divide 4.2 billion square feet by, let's say, 2,000 square feet as an average area of one flat, we're talking about, give or take, 20 lakh unsold houses in China. Imagine the scale. Now, the Central Bank of China has offered to provide a loan of about $42 billion to the states in China to buy these houses. But there seem to be at least 3 problems, if not more, with that plan. Number one, the local governments in China are already reeling under a $9 trillion debt. So any additional loan is not something they would want to take on. Number two, what would local governments actually do with these houses even if they were to buy them? After all, at some stage, they would want to sell them off. And guess what? China doesn't seem to have any buyers. And number 3, real estate players feel that stimulus offered by the government is too little and may force them to sell the unsold houses at a much lower price than they would have actually wanted to. This is leading to a massive sell-off in real estate stocks in both China as well as Hong Kong. With all this, one thing is fairly clear. China has no money to indulge in buying houses. Supply outweighs demand drastically. But cut to India and the story is the exact opposite. Demand is much stronger than supply in India, and the devil is in the detail. In contrast to China's crisis, India is actually experiencing a real estate boom. Currently, India's real estate sector contributes about 7% to the GDP and is expected to grow to about $5.8 trillion by 2047. And this would be accounting for about 15% of India's economy. Now, research reports notwithstanding, the trend line in India seems to be very clear. Look anywhere, speak to any broker, property prices are only rising. House prices in Bengaluru, Delhi, NCR, Ahmedabad and Pune have witnessed a double-digit growth in the Jan to March period this year compared to the same period last year. Unlike China, unsold inventory in India is actually dipping. Pune saw a dip of 10% or so in unsold houses between last year and this year, while the number of unsold houses in Delhi NCR are down about 8%. What does this mean? This means that people are in a position to buy houses in India. Robust demand, especially in premium and luxury housing, is driving sales, according to industry body CREDAI. And all this at a time when it's not just the prices which are high, but even interest rates. When you take that house loan, interest rates are also the highest they've been in recent past. Now, last year, India sold about 4.5 lakh crore rupees of houses. I'll give you some numbers. Last year, India sold 4.5 lakh crore rupees of houses, and if this were to grow modestly at 10% increase in price and 10% increase in the number of houses sold, we are looking at closing this year at about 5.5 lakh crore rupees. What is this 5.5 lakh crore rupees when converted to the dollar at an exchange rate of about 84 rupees? We are talking about $65 billion worth of housing is likely to be bought in India this year. I'll take you back to the China comparison. So while China is pumping in more than $130 billion to boost sales artificially, India is already organically buying $65 billion worth of houses with no stimulus whatsoever. Now, India's economic growth and the high consumption data justifies to some extent this property boom. But China's real estate crisis makes one wonder that is the dragon economy really growing at 5.2% when 1/3 of its GDP actually requires a government bailout? I'll leave you with that question.
And staying on with real estate, everyone wants to buy a home. It's the dream of most people, and hence there is no surprise that the real estate sector in India is in fact booming. But here's a twist. Budget homes or affordable housing is declining in both sales and supply. Is this a paradox, or is there a logical explanation to this? We'll find out. The Indian residential property sector in the top 7 cities showed strong growth in the first quarter of 2024, with both sales and new launches on the rise. However, not all segments of housing are selling like hotcakes. According to the latest data, luxury housing sales are on the rise while affordable housing continues to decline. In the first quarter of this year, about 21% of the units sold were luxury homes priced at 1.5 crore rupees and above. This is a significant increase from about 5 years ago when luxury housing had only a 4% share. In contrast, affordable housing was at its peak in the first 4 months of 2019 with 37% share of sales, but at the moment it's just about 20% for the first quarter or the first 3 months of 2024. At that time, in the first quarter of 2019, 44% of the new launches were in the affordable segment compared to just 9% for luxury homes. Fast forward to the first quarter of this year, the tables have turned. 25% of the new launches were luxury homes, while only 18% were affordable homes. We're talking about 2024 versus 2019. So the shift is driving developers to align their supply with prevailing demand, launching more luxury housing projects than ever before. Over the past 5 years, the supply and sales share of luxury homes has steadily risen. Before COVID-19, luxury homes accounted for about 11% of the new supply. In the first quarter of 2024, that figure jumped to about 25%. Meanwhile, the new supply share of affordable housing was shrunk and has shrunk. In 2019, it stood at 40%, but by first quarter of 2024, it had dropped to just 18%. So why is this happening? During economic upcycles, consumer confidence soars. People with more disposable income or access to credit are eager to invest in premium housing. They want better quality homes with superior amenities, driving up the demand for high-end properties. Developers follow the money. Premium projects offer higher profit margins compared to budget homes, which have tighter margins and greater financial risk. So developers focus more on luxury projects to in fact capitalize on this growing demand. Urbanization and rising aspirations among the middle class and the upper middle class also plays a big role. In rapidly growing cities, there is a strong desire for luxury living spaces. A growing professional class values comfort, convenience and status, pushing the demand for premium housing higher than ever. Meanwhile, the budget housing segment, driven more by necessity than by investment or lifestyle choices, doesn't see the same surge. Economic uncertainties, strict lending norms and less attractive investment returns keep this segment subdued during upcycles. In short, the decline in budget homes amid a real estate boom makes sense. Increased consumer confidence and changing urban aspirations all favor premium housing during economic upturns as opposed to the need for affordable housing, which is what we are seeing in the market at this point. We'll be back with more stories on the other side. Keep watching News 9.
How do you fulfill that promise? Because ultimately expectations have to be met. If you look at the political landscape, is it really changing for women? And what is the inability of the forces that dead bodies surface but not the living people?
I don't think anybody has isolated Ajit Dada Pawar. Ajit Dada has isolated himself.
That led to a lot of bad blood between the ruling partners.
It is not true. You know it very well, who these elements are, who these individuals are. And these are the very reasons why you see a division in the party.
Now this contest between Supriya Sule and Sunetra Pawar is really a proxy war between uncle and nephew, and it's being fought in the family bastion of Baramati.
This and more. Streaming on News 9 Plus. Subscribe and get free vouchers.
You're watching News 9. I'm Shweta Kothari. On Tuesday, 21st of May 2024, the Indian stock markets cleared another huge milestone. For the first time, the total market value of all listed companies on the Bombay Stock Exchange raced past the $5 trillion mark. With this, India became the fifth country in the world to have accomplished this feat, only after US, China, Japan and Hong Kong. It took India 17 years from the time its stock markets crossed 1 trillion market cap mark way back in May of 2007. While it has taken 10 years for the Indian stock markets to go from $1 trillion to $2 trillion, going up from 4 to 5 took just 6 months. This is the fastest pace of wealth creation for any market anywhere in the world. What do these numbers say about the Indian markets? Let's take a look. Well, Indian market capitalization to GDP ratio stands at 154%. Anything above 90% puts a market in the overvalued category. An overvalued market signifies the strength of confidence among investors in the stock markets. For the US markets, which are over 11 times Indian markets, this value stands at 185.5%. For Japan, it's 146.6%. So investor confidence is in fact high in the Indian markets. How difficult was the journey? Well, the last mile has been achieved despite pressures of heightened interest rates in the US that have been enticing foreign institutional investors away from the Indian bourses, rising oil prices and a generally unfavorable geopolitical environment. Picture this. For the first month of May of 2024, FIIs have pulled out close to 38,000 crores from the Indian stock markets. They had removed 35,000 crores in April and another 36,000 crores in January this year. In all, foreign institutional investors sold equities worth 1.2 lakh crore rupees in the year 2024. Where did this money come from? Well, the foreign institutional investors were busy pulling out money. Domestic institutional investors pumped in 1.9 lakh crore rupees into the Indian stock markets in 2024. Now, where did the investors put their money? What were the stocks, or were the stocks really driving investor confidence? Let's take a look. This landmark was crossed with most of the heavy lifting being range-bound within the broader markets. Simply put, the heavy lifting was done by big players in the markets like those in the Nifty 50. In particularly, the PSU stocks, which have been the key drivers for Indian markets. With over last 1 year, BSE PSU index witnessing a growth of over 100%. The BSE Sensex rose only around 20% during the same time. In the last 5 years itself, BSE PSU index has surged over 170%, almost double the growth rate of the Sensex at 90%. Mega listing like that of LIC also added a mammoth $78 billion to the total market cap figures on its own. Now, India boasts of over 100 stocks with a market cap of over $10 billion. China, whose market cap is almost twice as that of India, has around 130. The Indian economy has been on a path of increased growth over the last few years. The stock markets have been more than bolstered in their confidence. But there's also a word of caution. SEBI has raised concerns of froth in the mid-cap and the small-cap segments of the market. Over the last 1 year, the number of stocks with a price-to-earning ratio of over 50x have gone up from 41 to 104, with those of over 100 have gone up from 3 to 9. Vaulting confidence or unrealistic valuations? It could be either. Finance Minister Nirmala Sitharaman has voiced her concerns about individual and first-time investors playing in the futures and options markets. Let's listen in.
Any unchecked explosion in retail trading of futures and options can create future challenges, not just for the markets, for the investor sentiment, and also for household finances. Household finances have made a generational shift, which I just explained. We want to safeguard that. We want to ensure that that's not going to be shattered.
But if Prime Minister Modi's confidence is anything to go by, the election results would only render a huge boost to the Indian stock markets. We'll of course keep getting you all those details here on News 9 Live. And there is a new shining metal in the town, and this one's glittering more than gold. I'm talking about silver. Silver prices have zoomed to an all-time high owing to its utility beyond just ornaments. My colleague Krishna Kumar has the details.
Gold prices are up 16% this year. But guess what? It's not the most precious metal still. Silver, which is often referred to as poor man's gold, is the hottest metal at the moment. Silver prices have hit an all-time high of 93,400 rupees per kilogram. That's an over 35% rise this year already. Silver has beaten Sensex, gold and Bitcoin for the month of May 2024. In the month of May, while India's benchmark stock index, the Sensex, is down by 0.75%, gold has gained about 4.45% and Bitcoin is up just around 4%, whereas silver is up close to 11.3%. The rally in silver prices over the first half of the month of May accounts for nearly 60% of the gains recorded in the year 2024 so far. But why exactly is silver rising so much, so fast? For starters, it's important to understand that gold and silver prices largely move in tandem, and they tend to rise when there is macroeconomic uncertainty, geopolitical tensions, higher inflation, and there is the possibility of rate cuts. No wonder then that gold prices have been rising. However, silver comes with an added advantage over gold. Unlike gold, which is mainly used as a store of value and has only ornamental value, silver, in addition to having ornamental value, also has a utility value. It is used as an important industrial metal. Experts say about 50% of the silver produced across the world is used in industrial sectors, and that too in rapidly growing sectors like electric vehicles. Electric vehicles and even hybrid cars depend heavily on silver. Every electric vehicle has about 25 to 50 grams of silver in it, while every hybrid car uses 18 to 34 grams of silver. Not just that. The booming solar power industry is a significant driver of the demand for silver, as silver is essential for the manufacturing of photovoltaic panels required for solar power generation. Silver is also used in the production of 5G antennas. Another factor to keep in mind is the demand-supply mismatch for silver. While silver mining has been stagnant or has reduced over the course of the last decade, its usage has only been rising and rising by leaps and bounds. For example, in the year 2015, around 897 million ounces of silver were mined, whereas in the year 2023, just around 824 million ounces of silver were mined. During this period, industrial demand for silver rose from around 450 million ounces to over 650 million ounces. So the big question now is, will silver price continue to rise further? And more importantly, should you start investing in silver? Analysts say silver prices have the potential to rise further and is likely to outperform gold in the next few years. But do bear in mind that while historically silver's price movements are positively correlated with gold, as in when gold rises, silver too rises, silver prices are prone to higher volatility. That means silver tends to experience more significant price swings as compared to gold.
And that, of course, is on silver and why it is at an all-time high this time around. With that, it's time for a short break. We'll be back with more on the other side. Keep watching News 9.
$20,000 people dead and counting. What's happening in the United States of America is unprecedented. You will have to pay for this.
वो पूछते हैं कि हम कौन है गालिब, तुम बतलाओ कि हम बतलाएं क्या।
I told him, you do what you think is best, I will not insist.
This and more. Streaming on News 9 Plus. News is now content. Subscribe and get free vouchers.
Welcome back. I'm Shweta Kothari. You're watching News 9. It takes years to build a reputation, but only seconds to destroy it. That's exactly what's happened to India's reputation as a spice-producing and a spice-exporting nation. Indian spices and spice makers have found themselves in the dock. What is the drama around spices? Are Indian spices safe to consume, or do they potentially cause cancer? There should be a scientific answer to the presence or absence of ethylene oxide, but the view is divided at the moment. Let's take it from the top. On 28th of April, Hong Kong and Singapore food regulators flagged high levels of ethylene oxide in MDH and Everest masala mixes. It banned these spices from their market. Then begins the domino effect. Another report emerges that reveals nearly 1/3 of MDH masala powders have been rejected by the US Customs over the last 6 months. The refusal rate of MDH shipments in fact doubled from 15% to 31% over salmonella contamination since October of 2023. Now, last week, the United Kingdom announced it would implement additional control measures on all spices imported from India on the presence of ethylene oxide. Nepal too banned imports of these spices this week, flagging the exact same concerns. In between this, the Spice Board of India ordered an inquiry and food regulator FSSAI also springs into action. After weeks of testing, the revelations are contradictory at best. FSSAI says no traces of ethylene oxide have been found in a majority of the 300 samples of MDH and Everest spices that they have tested. The samples were picked up from testing and manufacturing plants in Maharashtra and in Gujarat right from the source. 28 out of 34 lab reports show no trace of pesticide that can potentially cause cancer. A report published in PTI about 2 days ago says exactly the opposite. That presence of ethylene oxide was in fact found in the products exported to Singapore and Hong Kong. A government official speaking to the media said strict action is being taken against Everest and MDH. Now, who should one believe? The testing authorities in Singapore, Hong Kong, US, UK, Nepal, or India's own FSSAI or the Spice Board? Scientific testing should result in either a yes or a no. That is one answer. Either there is or there isn't ethylene oxide. So why is there confusion? Amid all this, India's reputation, remember, as a global spice superpower has been dented. The impact can be significant. Spices form an integral part of India's export story. India's spice exports totaled $4.25 billion last fiscal. That's about 12% of the world's total spice export share from India and India alone, as per economic think tank GTRI or the Global Trade Research Initiative. Now, there are some pertinent questions that emerge from the entire spice saga as it unfolds, which only the Spice Board of India under the Ministry of Consumer Affairs and the food regulator FSSAI can answer. First, why aren't there regular testing mechanism in place to know exactly what chemicals or ingredients are and not part of every packet sold in India or exported from India? This would definitely help us rubbish claims authoritatively if the Indian products are getting cancelled globally. Next, why are we reactive and not proactive, in fact, in conducting these tests and setting standards? From Maggi to Cerelac to Bonvita and many other recent controversies have shown that regulators are sleeping at the wheel. Spices just got added to the long list of misses. And finally, who will bear the brunt of the damage to brand India? And the brands of spices that have made India's exports shine, why should MDH, Everest, or even brand India get compromised in the global arena? We'll leave you with those questions. And with that, it's a wrap on the show. Thank you for watching.
Start with the end in mind. You need to know where you want to reach. Every morning that we wake up, we are exercising our choice. The destiny is decided. The results are known that I'm going to win. Life of a goalkeeper is something which has always intrigued me. When you come into a stadium, this is the highest level of